Hi and welcome to the 24th and hopefully final month of 2020. Another year has passed us by, and this time last year we were very happy to see the end of 2020 and looking forward to a much improved 2021, notwithstanding we're still expecting some challenges. But I think it's fair to say we're pretty glad to put this one behind us just as well. We were pretty optimistic this time last year. We thought 2020 would be a reasonable year, and we had expectations that despite there'd be some challenges, particularly COVID and the geopolitical responses to COVID, that economies would be in reasonably good shape with a lot of the stimulus that was provided, and that generally speaking the adjustment had sort of taken hold and people had learned to live to some degree with the new way of working and operating in this environment. But 2021, as we now know, still full of lockdowns, still full of lots of uncertainty, but at least now the picture's emerging. So first of all, let's start with, so in 2021 we saw economies, we've learned now to live with COVID and the various strains of COVID in all of its machinations. The work from home, the balance of in and out of the office, and the ability to deal with snap lockdown and particularly border closures, although they're still very disruptive, particularly in Australia and for international travel and supply, it's fair to say that we're generally learning to live with that in a more of a sustainable, ongoing way. Supply chains, however, though, were one of the big themes, and in particular now starting to see the lack of investment in recent years in a lot of the inputs into goods and services, in particular mining and energy. And as a result of that, that combination is starting to see some fairly significant spikes in inflation. Now, the question going in through to 2022 is, are these well and truly expected events to be transitory, or what impact are they going to have longer term? And the other theme, which we thought probably should have unwound many years ago but has continued through 2021, is the valuation disparity between certain areas of the market. But in the end, markets, as we look today, are around about average for the year, but slightly up, sort of 10 to 12%, international and Australian equities as an example. And so it looks like 2021 will finish as a fairly average year from a market return perspective, which all in all we have to say is quite positive. But if we're to sum 2021 up in a word, it would have to be unprecedented. And there's a number of themes I want to just quickly run through that we think qualify. First of all, the value disparity. We've been talking about this now for a number of years, but I think this graph really shows it quite well. If we look at the return from US equities, the US share market, pretty much since the peak before the GFC, we see that the combined compound return from that market is around about 3 times. Whereas the entire rest of the world, so the world minus the US, has essentially tracked sideways in return during that period of time. Now, that doesn't mean with good active management we've been able to generate positive returns through that period of time. That's most definitely true. But what it does show you is that the vast majority of the market return has been driven by a very narrow portion of the world. And within that market, it's been driven almost entirely by large cap US tech stocks. And what that means is the whole rest of the world is now operating at valuation levels that are significantly below a very concentrated, very narrow part of the world. We haven't seen that type of valuation disparity at this level and sustained this long in recorded history, and so that's a theme that we're increasingly keeping an eye on going forward. Part of the driver of this has been the unprecedented amount of liquidity pumped into the markets by central banks and pumped into pockets by governments around the world. People have never had as much cash as they have today, and we've seen coming out of the GFC as people tended to build up their cash levels. Despite interest rates being at historic lows, the amount of cash essentially sitting in bank accounts and looking for a home has never been this high. This graph's actually from early in 2021. As it stands today, that's increased even further. So there's an unprecedented amount of cash sitting on the sidelines. Some of that's finding its way into real estate markets in particular, but there's still a lot of cash that hasn't actually been invested. But what we have seen is we've seen the re-emergence of the US retail investor. This particular graph looks at what percentage of shares are owned by retail investors in the US. And if we look back historically, high retail share ownership as a percentage always correlates with the top of markets. And so the fact that we're reaching unprecedented levels in terms of the amount of equities held by retail investors is another sign that particularly the US market is getting to a very, very extended sort of level. And probably a little bit surprising in that, if we look at what's driving that investment, is debt. Despite the fact there's a large amount of cash available, people seem to be hoarding that cash and in fact borrowing money to invest. Again, this graph looks at the amount of margin debt in the US, so money borrowed to buy shares, and that's at record levels. And so we've got this combination of the market at record levels, we've got the retail investors at record levels, and the amount of debt that they've taken on to borrow at record levels. Now, keeping in mind also that they're borrowing those at unprecedented or record levels in terms of the narrowness or the reduction in interest rates. These are all signs that that disparity between the US market and particularly the large cap US tech stocks and the rest of the world is due to unwind. So as we look forward to 2022, this is exactly the same. I think we're looking at exactly the same conditions going into 2022 as we faced in 2021. We're still learning to live with COVID and the various strains and find some degree of normality. We're now into boosters and different types of mask regimes, etc., that the world's still not on top of. But generally speaking, most economies are operating at least on a reasonable level and certainly much better than was predicted early in the pandemic. But supply chains and the investment in the things that build things are still there. Energy, mining and infrastructure are way behind where they need to be, and that was the case before COVID hit. So the supply constraints that we're seeing, the rising energy costs, the rising commodity costs that we're seeing that will feed into the rest of the economy, we think that theme is going to continue for some time. We don't believe at this stage that it will be structural, but we are looking at increased inflation coming through in 2022 for sure. The valuation disparity, I'm going to call it again. I'm going to say that it's going to end at some point. That may mean increased volatility in 2022. The good news being, though, that because the rest of the world and much of that world is at unprecedented valuation levels, there's plenty of opportunity set. And so whilst we're bracing ourselves, if you like, for some potentially heightened volatility, we're certainly not concerned about the ability to generate good, solid returns. In fact, to a large degree, because if anything, we're underinvested in that area of the market that is overextended, the return profile is actually quite good for us moving forward. But the big theme for us, particularly in 2021 and in 2020, has been regulation. So I'd like to thank all of you for your assistance in helping us deal with a lot of the new rules and regulations we've had to deal with around renewal notices and notices to various product providers and designer distribution obligation and target market determinations and compensation schemes of last resorts and all the other things that we've had to deal with, particularly in 2021. Unfortunately, that doesn't look like it's going to slow, and we are seeing a huge compacting of the advice market in Australia. In 2019, there was 28,000 financial advisors in Australia. It's now below 18,000 and is expected to stop somewhere around about 13 or 14,000 in the coming years. As a result of many advisors moving out of the market, part of that's a demographic issue, but a lot of it has come down to the massive increase in regulatory cost and compliance costs that we've had to deal with in recent times. So far, thanks to our obviously very hard-working and very competent staff, we've been able to digest most of that fairly well, and particularly because you, our clients, have assisted us greatly in getting back to us with the information we need and the sign-offs and all the bits and pieces, despite the fact that dealing with clients in a more digital way has become the norm. So I'd like to thank you very much for your assistance in that. We look forward to hopefully not causing you too much unnecessary disruption in 2022. But my word for 2022 is opportunity. I think, as I said before, there's an unprecedented amount of cash. There's lots of value in the world that has not yet been realised in particularly share prices in non-US markets in particular. And we think that we're very well positioned for that going forward. So yes, we think there'll be some volatility. Yes, there'll be some issues as we deal with various Delta and Omicron and other strains of COVID. But generally speaking, we think the world's already learnt how to live with COVID. And so hopefully the news in 2022 will continue to be better and certainly better than we've faced in the last 24 months. So again, from all of us at Complete Wealth, thanks very much for your support. This is a time of year we all think about family, and it's our families are supported by your families, and we can't thank you enough for your support, and we look forward to dealing with you again in 2022 and beyond. Thank you.